You know, usually when we talk about like a medical diagnosis, there's this inherent expectation of precision.
Right, like it's engineering or something.
Exactly. I mean, you break your arm, you go to the hospital, they do an x-ray, and it shows that jagged white line on your radius bone, and the doctor just points at the screen and goes, "There it is, broken."
It's very binary.
Hmm.
You're either fractured or you're intact.
Yeah, the rules of human anatomy provide a very comforting, neat categorization.
Usually, yes.
But then, you step into the world of complex neurodevelopment or like autoimmune conditions, and suddenly that beautiful, clean x-ray machine is just entirely
Oh,
useless.
completely. You're looking at a diagnostic landscape that is entirely murky.
Right. Symptoms overlap, conditions mask one another, and you have to rely on this constellation of subtle signals rather than just a single glowing white line.
It basically becomes a continuous spectrum of overlapping probabilities rather
Yeah.
than a simple yes or no.
Yeah. And that feeling, that totally disorienting sensation of stepping out of a clean binary world and plunging into a fluid reality, that is exactly what you experience when you leave the highly standardized world of commercial banking.
And step into the universe of non-banking financial companies in India, the NBFC sector.
Exactly. It is vast, it is incredibly diverse, and the rules of the game are completely fundamentally different. So welcome to another deep dive, and a special welcome to you, our dedicated learner.
Yes, welcome.
You have handed us a formidable challenge today. We're looking at Chapter 10 of the RBI Functions and Working Document, specifically the regulation and supervision of non-banking financial companies.
And I have to say, it is a notoriously dense text.
Oh, it's brutal.
It really is. It's packed with statutory clauses, sweeping historical turning points, and these layered regulatory frameworks that have just evolved over decades.
Which is exactly why we are here. You've asked us to act as your expert academic researchers and essentially instructional designers.
Because you need to master this material. Maybe it's for an upcoming exam or a major strategic meeting.
Right, but you don't have the hours required to parse Chapter 10, like 5 times over, just to extract the signal from the noise. So, our mission today is to construct a highly detailed, text-based mental blueprint.
Basically a comprehensive map of this entire domain.
Yes, and by the time we conclude this deep dive, you are going to have internalized a comprehensive 7-part architecture of Chapter 10.
The goal here is that you won't even need to return to the source text.
Exactly. You'll just pull up this mental map, and the underlying logic, the terminology, the data, it'll all just be right there.
So we're going to build this blueprint piece by piece.
Yeah, starting with Section 1, the core concept. We need an overarching title for our mental map. I'm thinking something like the Balancing Act, regulating India's non-banking financial companies.
I like that. It captures the tension perfectly.
Right. But before we get into all the statutory definitions, I was really trying to find a conceptual hook for what an NBFC actually represents in the broader economy.
Because the phrase non-banking financial company is just incredibly unhelpful.
It's the worst. It just tells us what the thing isn't. I mean, it's like describing a car as a non-flying transportation vehicle.
Yeah, it defines the entity entirely by its exclusion from a different club.
Exactly. So I was thinking about the music industry, right?
Okay, well, listening.
You have the massive global major label record companies, Universal, Sony, Warner. Those are your traditional commercial banks.
The giants.
Right. They are highly regulated. They deal with tens of millions of customers. They hold massive amounts of capital. But structurally, they can be slow to adapt.
Because they're rigid.
Yes. They mostly focus on the mainstream guaranteed pop hits because their overhead is just so incredibly high.
They really can't afford to take a risk on an untested, highly niche genre.
Right. And then you have the NBFCs. In this analogy, they are the indie record labels of the financial world.
Ah, okay. I see where you're going.
They're nimble, they're deeply embedded in local scenes, they are highly innovative, finding the niche artists, or in the financial sense, the underserved borrowers.
The specialized credit needs, the rural micro-entrepreneurs.
Exactly. The people that the massive major labels might completely miss or actively avoid because the risk models just don't fit their algorithms.
That is actually a very useful starting point for understanding their market function. The Reserve Bank of India, the RBI, essentially acts as the regulator for both these major labels and the indie labels.
And there are a lot of indie labels.
Oh, absolutely. With over 9,000 NBFCs currently operating in India, the sheer heterogeneity is staggering.
It's wild.
You have a company providing a 10,000 rupee microloan to a weaver in a rural village, And then you have another NBFC financing a multi-billion rupee infrastructure port project.
Which brings us back to that central tension, the balancing act from our title.
Right. The RBI must foster that indie innovation to ensure credit reaches the last mile of the economy while simultaneously mitigating risk.
I do want to push back on my own analogy already, though.
Oh, why is that?
Well, because if an actual indie record label goes bankrupt, a few bands lose their recording contracts. The global economy doesn't flinch.
That's true.
But if a massive NBFC fails, we are talking about a potential national crisis.
And that is precisely where the indie label analogy breaks down, which leads us directly to the statutory definition of what we're actually dealing with here.
Let's lay down the two-sentence summary for our blueprint.
Okay. NBFCs are vital financial institutions that perform bank-like functions, primarily credit intermediation and risk diversification, reaching underserved segments without holding full banking licenses.
Right.
The primary objective of their regulation and supervision is to maintain a fine balance between preserving the sector's innovativeness and dynamism while promoting systemic resilience and protecting consumers.
Okay, let's unpack that. Credit intermediation. Let's translate that
Yep.
for the listener.
It basically means taking money from entities that have a surplus and lending it to entities that have a deficit.
So they sit right in the middle. They intermediate.
Exactly.
But, I mean, if they do bank-like things and they intermediate credit, what is the absolute defining line here? If I'm a regulator, how do I know I'm looking at an NBFC and not a bank?
For that, you have to look at Section 45 IF of the Reserve Bank of India Act.
Okay, Section 45 IF, let's make sure we bullet point that in our mental infographic.
It is the cornerstone. The RBI Act defines an NBFC as a company registered under the Companies Act that is a financial institution, carrying out activities like lending or receiving deposits under various schemes.
But here's the critical dividing line, right?
Yes, they lack the full suite of banking privileges.
Okay, what privileges are we talking about specifically? Because that's the key.
The most fundamental one is the acceptance of demand deposits.
Meaning like a savings account or a current account where I can walk up to an ATM or a teller and demand my money back at any second without prior notice.
Correct. Traditional banks rely heavily on demand deposits. NBFCs are strictly prohibited from accepting them.
So no checking accounts, basically.
Right. If an NBFC accepts public money, it must be a term deposit.
Meaning the money is locked in for a specific period, say 12 months or 36 months.
Exactly.
So the NBFC knows exactly how long they have the money, which theoretically makes their lending models more stable because they don't have to worry about a sudden Tuesday morning bank run where everyone demands their cash at once.
Theoretically, yes, that's the idea.
Yeah.
The second major exclusion is that NBFCs do not form part of the national payment and settlement system.
Meaning?
They cannot issue checks drawn on themselves.
Like, break that down for me. If I get a loan from an NBFC, they give me the money. How is that different from a bank?
Well, if you have an account with the State Bank of India, you can write a check to your landlord, and the RBI's clearinghouse processes that transaction between SBI and your landlord's bank.
Because the bank is integrated into the very plumbing of the economy's money movement.
Exactly. An NBFC is entirely outside that plumbing. You cannot write a check from your NBFC account. They are fundamentally insulated from the core clearing mechanisms.
Ah, I see. So they are lending money, but they aren't participating in the daily velocity of money movement in the same way.
Precisely. And because they aren't in the pay and settlement system, and they don't hold demand deposits, the RBI historically viewed them as much less of a systemic risk than commercial banks.
Historically.
Yes, historically.
Which perfectly transitions us into Section 2 of our blueprint, the chronology.
Right.
Because to truly master this material for an exam, you can't just memorize the rules that exist today.
No, you have to understand the specific crises that force those rules into existence.
Right. We need to map out the historical timeline of NBFC regulation.
And you'll notice that regulatory evolution is almost entirely reactive. You rarely see a regulator preemptively build a massive compliance framework just in case.
Yeah, exactly. Nobody builds a four-way traffic light in the middle of a desert intersection just because cars might crash there one day.
No, you wait until a catastrophic collision actually happens.
Right. The public demands action, and then suddenly you have red, yellow, and green lights, speed cameras, and a dedicated traffic cop.
That is exactly how Chapter 3B of the RBI Act evolved. So let's lay down the timeline markers.
Let's do it in chronological bullet points. What's the first one?
The very first marker is 1963. Chapter 3B is formally inserted into the RBI Act.
1963.
Okay. For the very first time, this grants the Reserve Bank of India explicit regulatory and supervisory powers over non-banking financial companies.
What were they actually doing in 1963, though? Was it heavy-handed oversight?
Not at all. In 1963, the RBI's primary concern was simply controlling deposit acceptance.
Just watching the money pile up.
Essentially, yes. They were watching these non-bank entities pool public money, and they just wanted to track the volume of those deposits to ensure it wasn't interfering with the broader monetary policy.
So they were basically just counting the cars passing through the intersection.
Dipping a toe in the water.
We acknowledge you exist, we are tracking your deposits, but we aren't telling you how to run your business.
Correct. And this observational stance largely continued for decades. But then we must jump forward to 1992, which is a critical marker.
1992. Okay, we've got the Shah Committee.
Yes.
Now, 1992 is a fascinating time in India. The economy has just been liberalized in 1991. The license raj is being dismantled. Foreign capital is entering. There are massive animal spirits in the market.
Exactly. The financial sector was rapidly expanding, and NBFCs were proliferating everywhere to capture the new demand for credit that traditional banks were just too slow to service.
So what does the Shah Committee do?
The Shah Committee releases a report highlighting an urgent need to dramatically expand the regulatory and supervisory focus on NBFCs.
They realized that merely tracking deposits was no longer sufficient.
Right. These entities were becoming deeply intertwined with the broader economy.
The Shah Committee sounds the alarm. They say, the intersection is getting too busy, we need a traffic light. But a committee report rarely changes the law overnight, right?
No, it usually takes a disaster. And that disaster arrives in 1996.
1996, the watershed year.
This is a massive, bold marker for our timeline. The failure of CRB Capital Markets.
What actually happened with CRB Capital?
So CRB Capital was a very prominent, aggressive NBFC. In the booming mid-90s, they attracted massive amounts of public deposits by offering incredibly high interest rates.
So retail investors, regular people looking for a better return on their savings than a bank could offer, poured their money into CRB.
Exactly.
And what was CRB doing with that money?
They were funneling it into high-risk areas, unlisted corporate shares, speculative real estate, and questionable group companies.
Uh-oh.
They created a severe asset-liability mismatch.
Which means they owed the public fixed returns in the short term, but their money was locked up in highly illiquid, risky long-term bets.
Right. So when the market turned and some of those bets soured, they couldn't meet their obligations. The company collapsed.
And because they had taken so much money directly from retail depositors, it wasn't just wealthy institutional investors taking a haircut, it was middle-class savings being totally wiped out.
Panic set in. There was a run on other NBFCs. It damaged trust in the entire financial ecosystem.
It was the catastrophic intersection collision the Shah Committee had warned about.
Exactly. Which brings us to the very next year, 1997.
The immediate, sweeping regulatory response.
The 1997 amendments to Chapter 3B of the RBI Act fundamentally altered the existence of an NBFC in India. The era of light touch observation was totally over.
What did they do?
The RBI introduced compulsory registration. You could no longer just hang a shingle and call yourself an NBFC.
They also introduced the Minimum Net Owned Fund, or NOF, which we are going to define strictly later.
Yes, they mandated that a company must have a minimum baseline of its own unencumbered capital just to be allowed to operate.
Okay, so a minimum capital buffer.
Furthermore, they mandated the creation of a statutory reserve fund.
How did that work?
Every single year, an NBFC was legally required to transfer 20% of its net profit into this reserve fund before declaring any dividends.
Wow, that is a massive shift. They are forcing these companies to build their own shock absorbers.
Yes, exactly.
If you make a profit, you can't just distribute it all to your shareholders. You have to lock 20% of it away in a vault to protect the depositors in case you have a bad year.
The 1997 amendments changed the regulator's role from a statistician to a prudential supervisor. They began regulating the health of the balance sheet, not just the size of the deposit base.
Okay, moving down our timeline blueprint, we have 1999.
In 1999, the RBI flexes its new prudential muscles. They take that minimum net owned fund requirement for fresh registration and enhance it significantly.
Raising it from 25 lakh to 2 crore.
Yes.
They raised the barrier to entry almost tenfold. Why?
To weed out the unserious players. If you cannot raise Euro 2 in clean equity, you do not have the financial sophistication or the shock absorption capacity to be managing other people's money. It was essentially a quality control measure.
That makes a lot of sense. So we jump forward 15 years to 2014. The financial landscape has completely transformed since the late 90s.
It has. In 2014, the RBI conducted a major review of the regulatory framework. And the most critical takeaway for our deep dive is that the threshold for defining systemic significance was moved. Previously, An NBFC with an asset size of 100 crore was considered systemically important and subject to tighter rules. In 2014, the RBI raised that threshold to 500 crore.
I always find this counterintuitive. I mean, if you raise the thresholds from 100 to 500 crore, you are explicitly deciding to apply your strictest rules to fewer companies. Hundreds of companies that were between 100 and 499 crore suddenly fell out of the systemically important bucket. Isn't that dangerous?
Well, it sounds dangerous until you factor in inflation and economic growth.
Yeah.
A 100 crore company in 1999 was a giant. By 2014, a 100 crore balance sheet was just a mid-sized regional player.
So the scale of the economy changed.
Right. The RBI has finite supervisory resources. If they treat every 100 crore company as a systemic threat, they dilute their focus.
If everything is an emergency, nothing is.
Precisely. The failure of a 100 crore NBFC in 2014 would be unfortunate for its investors, sure, but it would not threaten the national economy.
Oh.
The RBI needed to refocus its most intense, granular scrutiny on the true titans, the 500 crore, 5,000 crore, 50,000 crore behemoths whose failure could actually cause a systemic ripple.
So it was really a calibration of the regulatory lens.
Exactly.
Okay, our next timeline marker is a global one, and it's fascinating. October 22, 2018.
The Financial Stability Board, the FSB, officially announces the replacement of the term shadow banking with non-bank financial intermediation, or NBFI.
We are definitely going to dig deeply into the psychology of that name change when we get to our cause and effect section, because the phrase shadow banking carries so much baggage.
It really does.
But for now, we will mark 2018 as the end of the shadow banking era, rhetorically speaking. Next is 2019.
2019 represents a massive consolidation of RBI authority. Significant legal amendments give the RBI incredibly sharp teeth.
What kind of teeth?
They gain the statutory power to unilaterally remove NBFC directors, to supersede boards of directors entirely, and to resolve NBFCs.
Resolve? Let's translate that from central bank speak.
It means if an NBFC is failing and threatens the system, the RBI can step in, fire the management, take over the steering wheel, and forcibly amalgamate it with another company, or just break it apart and sell its assets.
Wow.
They don't have to wait for a messy, years-long bankruptcy court process.
That is the ultimate regulatory power, the power of life and death over the corporate entity.
It is. Also in 2019, the regulation of housing finance companies, HFCs, was transferred from the National Housing Bank directly to the RBI, bringing a massive segment of the credit market under one unified umbrella.
Which brings us to the culmination of the timeline, the modern era, October 2021 and October 1st, 2022.
Yes. In October 2021, the RBI issues the Scale-Based Regulation SBR framework. And exactly 1 year later, on October 1st, 2022, the SBR officially goes into effect.
Scale-based regulation. This is the paradigm shift of Chapter 10.
It is the complete abandonment of the old binary way of thinking.
Right.
For decades, the primary regulatory dividing line was simply, do you accept public deposits or do you not? If you took deposits, strict rules. If you didn't, lighter rules.
But the markets evolved.
Massively. Non-deposit-taking NBFCs grew to massive sizes by borrowing from banks and mutual funds. The SBR recognizes that size and interconnectedness matter just as much as retail deposits.
So it replaces the binary with a highly nuanced, proportional, four-tiered pyramid.
Exactly.
We will explore every single layer of that SBR pyramid in our matrix section later, but looking back at the timeline we've constructed from the mere observation in 1963 to the crash of 96, the NOF rules of 97, the threshold calibration of 2014, the absolute powers of 2019, and the SBR paradigm of 2022, you can really trace a clear arc.
An arc of a regulator desperately trying to keep pace with a rapidly mutating financial organism.
It is a continuous game of cat and mouse.
Very much so.
All right, we have our historical context locked in. Now, moving to Section 3 of our blueprint. To truly build this out for an exam, we need to speak the exact language of the text.
Right.
It's time to transition into the key terminology and definitions. In any high-level assessment, if you vaguely describe a concept, you fail. You must use the strict legal jargon.
Terminology is the absolute foundation. If you misdefine a term, your subsequent analysis of how that entity is regulated will be fundamentally flawed.
So let's start with the most basic sounding term, which I guarantee is a trap. Let's make sure we bold this in our mental infographic. Financial institution.
Legally, under Section 45 IC of the RBI Act, a financial institution is defined as carrying on a business that involves loans and advances, the acquisition of shares, stocks or bonds, hire purchase insurance, or chit fund activities.
Okay, making loans, buying corporate bonds, running insurance, that all sounds perfectly standard. Where is the trap?
The trap lies in the explicit exclusions. The definition specifically states the financial institution does not include any institution whose principal business is agriculture, industrial activity, or the purchase and sale of any goods.
Ah, so if my primary business is manufacturing tractors, I'm not a financial institution, even if I engage in some financial activities on the side.
Correct. But this begs the most important question in the entire chapter. How does the RBI legally define the word principal?
Exactly. I mean, if I'm the CEO, I might subjectively feel my principal identity as a tractor manufacturer. But the RBI can't rely on my feelings.
Nope, they cannot.
Which brings us to the most critical, bolded, underlined term in our blueprint, the Principal Business Criteria, or PBC.
Yes. The PBC is the determinant mathematical test for identifying an NBFC. It is a dual-condition tripwire. It relies on a very strict 50-50 rule.
Explain the two conditions.
Condition 1. A company's financial assets must constitute more than 50% of its total assets. And for the sake of precision, that is total assets netted off by any intangible assets.
Okay, assets over 50%.
Condition 2. Its income from those financial assets must constitute more than 50% of its gross income.
I want to spend a moment on this because I really want to make sure the mechanics are crystal clear. Let's invent a scenario.
Okay, shoot.
I own a massive steel factory. It is a sprawling industrial complex. Thousands of workers, blast furnaces, smokestacks. In my mind and on my corporate letterhead, I am a steel manufacturer. But over 20 years, the factory has generated a lot of surplus cash. Instead of letting it sit in a low-yield bank account, I started a corporate treasury desk. I hired a few guys to manage a massive portfolio of loans and corporate bonds.
Happens all the time.
If, during one particular financial year, the value of that loan portfolio grows so large that it crosses 51% of my total factory assets, and the interest generated from those loans hits 51% of my total gross income, am I suddenly an NBFC?
Yes, absolutely and unequivocally.
Wait, really? Even though I'm still running a massive steel factory, even if I argue, look out the window, look at the blast furnaces, I am industrial.
The regulator will just tell you to look at your balance sheet. The RBI does not care about your smokestacks. If both your assets and your income cross that 50% threshold into financial territory, you have crossed the regulatory perimeter.
Wow.
You must immediately register as an NBFC and comply with all RBI prudential norms.
But what if it's just a fluke year? What if the steel market crashes? So my income from selling steel drops to almost zero, but my bond portfolio keeps paying steady interest. Suddenly, my financial income is 90% of my total income, just because the industrial side had a bad year. Do I get a pass?
Well, the 50-50 rule is generally assessed based on audited balance sheets over a sustained period, but crossing the tripwire triggers immediate scrutiny. You cannot use a temporary industrial downturn as an excuse to operate an unregulated financial empire on the side.
Oh, that makes sense.
The mechanical rigidity of the 50-50 rule is deliberate. It completely prevents massive corporations from hiding shadow banking operations inside industrial conglomerates.
It's an inescapable mathematical net, both assets over 50% and income over 50%. Incredible. Okay, let's bold the next term in our blueprint, non-bank financial intermediation, NBFI. We touched on this.
Yes, NBFI is the modern global umbrella term. It is a broad measure encompassing all non-bank financial entities. It technically includes institutions that are not central banks, not commercial banks, and not public financial institutions.
And as we noted, it's the official replacement for the stigmatized term shadow banking.
Exactly.
Okay, next bold term, public funds. We said earlier that taking public deposits triggers heavier regulation, but the text indicates public funds is much broader than just a retail savings deposit.
Significantly broader. Public funds obviously includes direct public deposits, but it also includes funds raised indirectly through commercial paper, debentures, intercorporate deposits, and this is key, even bank finance.
Wait, stop. If an NBFC goes to the State Bank of India and takes out a standard corporate loan, the RBI considers that NBFC to be operating with public funds.
Absolutely. Think about the chain of custody. Where did the State Bank of India get the money to lend to the NBFC?
From the savings accounts of millions of regular citizens.
Precisely. The NBFC is indirectly leveraging the savings of the general public. If the NBFC defaults on the bank loan, the bank takes a hit, which ultimately threatens the public's deposits. Therefore, utilizing bank finance is utilizing public funds by proxy.
That interconnectedness is wild. Is there anything that isn't considered a public fund?
Yes, there is a crucial exception you must know for the exam. Public funds exclude money raised by issuing instruments that are compulsorily convertible into equity shares within a period of 10 years.
Why? Why does a 10-year convertible instrument get a pass?
Because of the nature of equity versus debt.
Hmm.
If I lend you money and you are legally obligated to convert that debt into ownership shares of your company within a decade, I am not really a creditor expecting my cash back.
Right.
I am a future owner taking on business risk. Capital is a buffer. Debt is an obligation. The RBI is primarily concerned with protecting creditors, not equity shareholders who willingly take on business risk.
That makes perfect sense. Debt converting to equity is basically delayed capital. Speaking of capital, let's tackle the most intimidating calculation in the chapter. Let's make this a major bullet point. Net own fund, NOF.
Yes, this is the survival metric.
This is the duo crore, soon to be 10 crore, minimum barrier to entry. How do we actually calculate it?
It requires a specific two-step formula to prevent accounting tricks.
Okay, step 1.
Step 1. You calculate the base owned fund. You take your aggregate paid-up equity capital and add your free reserves.
So the money the founders put in plus the profits they've kept in the business?
Right. But then you must subtract certain items. You subtract any accumulated losses. You subtract deferred revenue expenditure, and you subtract other intangible assets.
Let's translate those subtractions. Why subtract accumulated losses?
Because if you started with 10 crore, but you've lost 3 crore over the last 2 years through bad loans, your actual real-world buffer is only 7 crore. You cannot claim historical capital that has already evaporated.
Fair enough. What is deferred revenue expenditure? Why is that subtracted?
Imagine an NBFC spends 50 crore on a massive nationwide advertising campaign.
Okay.
Under certain accounting rules, instead of taking that massive 50 crore hit to their profit in year 1, they can defer it, spreading the cost over 5 years on their balance sheet. It sits on the asset side as deferred revenue expenditure.
Ah, it's an accounting fiction to smooth out earnings.
Exactly. It is a paper asset.
Right.
If the NBFC goes bankrupt tomorrow, they cannot sell a past advertising campaign to pay back their depositors. It has absolutely zero liquidation value. So the RBI forces them to subtract it from their capital calculation.
The RBI only wants to see hard, liquid reality. Same logic for intangible assets, I assume.
Yes. Patents, trademarks, goodwill.
Mm-hmm.
You cannot easily liquidate a brand name during a weekend financial panic. The RBI demands tangible skin in the game.
Okay, so that is step 1. Capital plus reserves minus the fictional or illiquid stuff. What is step 2?
Step 2 prevents the phantom capital trick. You take that owned fund and you must subtract your investments in shares of other NBFCs, subsidiaries, or companies in the same group, but only to the extent that those investments exceed 10% of your owned fund.
Let me make sure I wrap my head around this.
Take your time.
Let's say I am a billionaire and I want to start 5 different NBFCs. I have 10 crore in cash. I put the euro crore into NBFCA. Then NBFCA takes that same euro 10 crore and invests it into NBFCB as equity.
Right.
NBFCB invests it into NBFCC. If you just look at their balance sheets in isolation, all 5 companies claim to have 10 crore in capital. But in reality, there is only one pile of 10 crore moving in a circle.
That is exactly this systemic vulnerability the
Yeah.
10% rule is designed to destroy. It is called double leveraging.
Because if A fails...
If NBFC-A fails, the capital of B, C, D, and E instantly vanishes because it was all the exact same money. The RBI says, if you invest more than 10% of your capital into your own sister companies, we will deduct that excess from your net owned fund calculation.
Wow.
It forces every single entity in a corporate group to bring fresh independent capital to the table.
That is a brutally elegant piece of regulation. It completely short-circuits corporate shell games. Okay, our terminology list is robust. Let's move to a massive shift in how these companies actually measure their financial reality. Let's bold the term. IND AS.
IND AS stands for the IFRS Converged Indian Accounting Standards. The critical transition here is moving from a rigid, rule-based accounting framework to a principle-based framework.
What is the practical difference for an NBFC?
The most profound difference, and the one the exam will definitely target, is the requirement for an expected credit loss, ECL model, for recognizing POS loans.
Well, let me try to explain this, and you tell me where I'm wrong.
Go for it.
In the old days, under the incurred loss model, if I lent you money, I didn't record a loss on my books until you actually stopped paying me. I waited for the default to physically happen. It's like I don't buy an umbrella until I am actively getting wet.
That is a perfect analogy for the incurred loss model. It is completely reactive.
But under the expected credit loss, or ECL model, I have to look at the forecast. If I lend you money and I know your industry is struggling and macroeconomic indicators are trending downward, I have to project the probability that you might default in the future. It's like the meteorologist says there is an 80% chance of rain tomorrow, so the accounting rules force me to buy the umbrella today and record the expense immediately.
You nailed it. You must estimate the credit losses you expect to happen over the lifetime of the loan based on historical data, current conditions, and reasonable macroeconomic forecasts. You must provision for the loss before the loss actually occurs.
That sounds incredibly prudent. It forces them to be forward-looking, but I see a glaring issue here.
Which is?
Subjectivity. If I'm the CEO of an NBFC and my bonus depends on high profits, my reasonable macroeconomic forecast is going to be incredibly optimistic. I will predict sunny skies so I don't have to provision for losses, while a more conservative CEO down the street might look at the exact same data and provision heavily.
You have hit on the exact regulatory nightmare of IND AS. It introduces massive management discretion.
Yeah.
Two different NBFCs with the exact same loan portfolio could report wildly different profit numbers simply because their internal ECL models utilize different assumptions about the future.
Which means there is a loss of strict comparability. The RBI can no longer line up 10 balance sheets and compare them apples to apples.
Precisely, which is why the RBI could not just hand over the IND AS rulebook and walk away. They had to issue highly specific regulatory guidance on how to implement the ECL models, imposing guardrails on management's assumptions to enforce consistency and enable reliable supervision.
Okay, final bolded term for our glossary.
IKP.
The Internal Capital Adequacy Assessment process. This is a vital requirement under the new SBR framework, specifically for the middle and upper layer NBFCs. What does it actually mean in practice?
Traditionally, an NBFC would look at the RBI mandate, say a 15% minimum capital ratio, and say, okay, we hit 15.1%, we are compliant, let's stop worrying.
Right.
ICAIC changes that entirely. It mandates that the NBFC's board of directors must proactively make a realistic internal assessment of their own specific capital needs to support all of their idiosyncratic business risks.
Not just credit risk.
Exactly. Credit risk, yes. But also market risk. What if interest rates spike? Operational risk. What if our primary data center is destroyed by a flood or we suffer a massive cyber attack?
Ah, I see.
An NBFC, heavily exposed to volatile commercial real estate, might internally conclude through their ICAP that a 15% capital ratio is entirely insufficient for their specific risk profile, and they actually need 18% to survive a stress event.
They are legally mandated to actively grade their own homework, find their own flaws, and hold capital against the nightmares the RBI hasn't even thought of yet.
It forces a culture of internal risk management rather than mere external compliance.
That is brilliant. Okay, we have built a formidable terminology foundation. Let's pivot to Section 4 of our blueprint. We need to map out the important figures and names, specifically the division of labor. Because as powerful as the RBI is, it doesn't regulate every single financial entity in India.
It is a complex, multi-jurisdictional ecosystem. We have already highlighted the historical role of the Shah Committee of 1992, which triggered the Prudential era.
And we discussed the Financial Stability Board, FSB, driving the global nomenclature shift to NBFI in 2018.
Yes. But domestically, the landscape is heavily divided.
The overarching principle here, as I understand it, is avoiding regulatory overlap. Avoiding dual regulation. If you have two different cops trying to direct traffic in the same intersection, you get chaos and regulatory arbitrage.
Exactly. If another competent, specialized statutory body is already watching an entity, the RBI strategically steps back. For exam purposes, you must know these exemptions intimately. Let's list them out.
Let's run through them. If I run an alternative investment fund, or I am a merchant banker or a stock broking company, I am technically engaged in financial activities, but the RBI does not want me to register as an NBFC. Why?
Because you fall strictly under the jurisdiction of the Securities and Exchange Board of India.
Oh, SEBI.
SEBI is the specialized COP for the capital markets. A stockbroker meets the technical Section 45I definition of a financial institution, but the RBI exempts them because SEBI already enforces rigorous capital, margin, and conduct rules tailored specifically for equities trading.
It's a specialized division of labor. What about insurance companies?
They are comprehensively regulated by the Insurance Regulatory and Development Authority, IRDA. The mathematics of actuarial science and insurance float are entirely different from lending, requiring a dedicated regulator.
Makes sense. Mutual benefit companies and media companies.
Regulated by the Ministry of Corporate Affairs, MCA.
And chit companies. Chit funds are ubiquitous across India.
Chit funds present a unique jurisdictional quirk. They're primarily regulated by state governments.
Why the states?
The local nature of chit funds makes decentralized state oversight much more practical. However, there is a nuance you should note. If a miscellaneous non-banking company, an MNBC, manages chit funds, they must still adhere to certain RBI directions regarding deposit taking. But the primary regulatory burden remains with the states.
So SEBI takes the markets, IRDA takes the insurers, MCA takes the needy companies, and state governments take the chits. Is there any other major player in this ecosystem we need to list?
Yes, we must highlight the National Payments Corporation of India, NPCI.
But the NPCI isn't a regulator, are they?
Not in the prudential sense, no, but they are the central technological driver of the entire fintech evolution in India.
Ah, UPI.
Exactly. The NPCI built the Unified Payments Interface, the UPI. The explosion of innovation happening in the NBFC space, instant digital lending, microcredit at the point of sale, seamless repayment collections, is entirely reliant on the digital rails built by the NPCI.
They poured the concrete for the digital highway that the new age NBFCs are racing their sports cars on.
Exactly. You cannot understand the modern growth trajectory of NBFCs without understanding the enabling infrastructure of the NPCI.
All right, we have the history, the terminology, and the players. Now is time for Section 5. We need to load our mental blueprint with the hard empirical data. High-level conceptual understanding is great, but exams demand precision. We need to abstract the vital statistics, the specific percentages, the glide paths as isolated high-impact bullet points.
The quantitative metrics are the skeleton of the regulatory framework.
Let's do it. Rapid fire. First bullet point.
Let's start with sheer scale. There are currently over 9,000 NBFCs registered and operating in India.
9,000. That is a staggering perimeter to patrol. Imagine being the RBI supervisor trying to monitor 9,000 distinct balance sheets.
It is an immense logistical challenge, which is why the next statistic is so revealing regarding concentration. Of those 9,000 NBFCs, more than 96% by number fall under a single massive regulatory category, the NBFC Investment and Credit category, NBFC ICC.
Wait, 96%? So all those highly specific niche categories we're going to discuss later, the infrastructure financiers, the microfinance institutions, the account aggregators, they collectively make up only 4% of the actual number of registered companies.
By sheer number of registrations, yes.
Yeah.
The reason is historical. In the past, there were separate categories for asset finance companies, loan companies, and investment companies.
And they just lumped them together.
The RBI realized the boundaries between these business models were blurring entirely. A company would lend money, finance a tractor, and invest in bonds simultaneously. So the RBI merged them all into the massive catch-all bucket of the NBFC ICC to harmonize regulations.
Okay, bullet points. 9,000 total, 96% in the ICC bucket. We already covered the 50-50 test for principal business criteria. Let's revisit the capital requirements. The net owned fund. We said it was jumping from euro 802 to 10 crore. What are the specific dates for that transition?
The RBI is implementing a glide path. Under the SBR framework, the ultimate NOF requirement for the core categories NBFC ICC, NBFC MFI, and NBFC factors is 10 crore, which must be achieved by March 31st, 2027.
But they have interim milestones to ensure companies are actually making progress, right? Put that in a sub-bullet.
Yes. For an NBFC ICC currently sitting at the old euro crore minimum, their interim target is to reach 5 crore by March 31st, 2025, on their way to the full tier crore by 2027.
It gives them a few years to retain earnings or find new equity investors. Which brings me to the next major bullet point, the other major glide path, which I think is the most economically fascinating part of this chapter, the non-performing asset, or NPA, classification.
Yes. Historically, smaller NBFCs had a very lenient timeline for recognizing bad loans compared to commercial banks. Under the SBR, the RBI is forcing alignment.
Give me the numbers.
For the base layer NBFCs, the glide path for classifying a loan as an NPA is tightening systematically.
Yeah.
It was 150 days overdue by March 31st, 2024. It drops to 120 days by March 31st, 2025. And it finally aligns with the strict banking standard of 90 days by March 31st, 2026.
I want to pause and analyze this because it perfectly illustrates the philosophy of regulation. If the RBI firmly believes that 90 days is the mathematically correct metric for recognizing a bad loan, which is the global banking standard, why employ this agonizingly slow multi-year glide path? 150 days, wait a year. 120 days, wait a year. Why not just rip the Band-Aid off and say, effective tomorrow, 90 days is the rule? Why coddle them?
It is a phenomenal question, and it goes to the very heart of systemic stability. Let's play out your scenario. The RBI rips the Band-Aid off. They issue a circular tonight. Tomorrow morning, the NPA norm is 90 days. what physically happens tomorrow morning.
Thousands of NBFCs wake up, look at their loan portfolios, and realize that a massive chunk of loans that were 100 days overdue, which were considered perfectly healthy standard assets yesterday, are suddenly legally classified as non-performing assets.
Exactly. And when an asset becomes non-performing, what must the NBFC do under the accounting rules?
They have to immediately provision for the loss. They have to take money out of their profits and set it aside to cover the bad loan.
Precisely. So overnight, their reported profitability completely collapses. Because their profits collapse, their capital adequacy ratios plummet. Their net-owned funds might drop below the statutory minimum. Suddenly, you've triggered a wave of artificial regulatory insolvencies across the entire financial sector.
Artificial insolvencies. Because the actual borrower didn't change their behavior overnight. The real-world cash flow didn't change. Only the accounting ruler changed.
Exactly. And what happens when the market sees hundreds of NBFCs suddenly reporting massive losses and breaching capital requirements?
Panic. Pure panic.
Panic. Commercial banks instantly freeze all credit lines to the NBFC sector. Mutual funds refuse to roll over their commercial paper. The NBFCs, starved of funds, immediately stop lending to the real economy. Truck drivers can't get loans to buy trucks. Small businesses can't get working capital. The economic engine seizes up.
Wow. So the regulatory shock to the system would be infinitely worse than the disease they were trying to cure.
A catastrophic systemic shock. The glide path is not about coddling bad businesses. It is a highly engineered macroeconomic tool. It brings smaller entities up to rigorous prudential standards, but it gives them the necessary runway to adjust their internal business models, tighten their collection practices, raise fresh capital, and absorb the accounting impact gradually.
You turn the dial slowly so the boiler doesn't explode.
Exactly.
That is a difference between reading a textbook and understanding reality. Okay, let's hit the rest of the vital stats. Next bullet point, leverage limits.
For the base layer, the leverage ratio ceiling is set at 7 times.
Meaning their total outside liabilities, all the money they have borrowed, cannot exceed 7 times their own internal unencumbered capital.
Correct. It caps how much debt they can pile onto a small equity base. Note for the exam, this 7x limit excludes NBFC MFIs, which are subject to different specific metrics due to the nature of microfinance.
Capital adequacy ratios. You threw some acronyms at me earlier. What's the stat here?
For the middle layer, the minimum CRAR, the capital to risk-weighted assets ratio, is 15%.
Before you give me the next stat, we need to quickly demystify risk-weighted assets for the listener. It's not just 15% of their total loan book, right?
Correct. Not all loans are equally dangerous. If an NBFC lends 100 to the central government, the risk of default is essentially 0. That asset might have a 0% risk weight.
Right.
If they lend 100 to a highly volatile, unproven tech startup, the risk is massive. That asset might have a 100% risk weight. You multiply the loan value by its risk weight, sum it all up, and the NBFC must hold capital equal to 15% of that risk-weighted total. It forces them to hold more capital if they make riskier bets.
Got it. So middle layer is 15% CRAR. What about the elite upper layer?
For the upper layer, the RBI introduces an even stricter metric, a Common Equity Tier 1, or CET1 requirement of 9%.
What is the difference between standard capital and common equity tier 1?
Quality. CET1 is the purest, highest quality form of capital. It consists primarily of common shares and disclosed reserves, actual permanent money that belongs to the shareholders.
Ah, no funny business.
Right. It excludes hybrid instruments or subordinated debt that masquerade as capital but might actually have repayment obligations. The RBI is saying to the largest NBFCs, you cannot rely on financial engineering to meet your capital requirements. You need 9% of the hardest, most permanent equity available.
Pure shock absorbers. Okay, next stat, the IPO funding limit.
A very specific SBR intervention. There's a strict ceiling on IPO funding of 1 crore per individual borrower.
Why did the RBI feel the need to cap that?
During bull markets, high net worth individuals would borrow massive, ungodly sums of money from NBFCs purely to aggressively oversubscribe to initial public offerings. They would borrow 50 crore, flip the allotted shares on listing day for a massive profit, and pay back the NBFC.
It's pure leverage speculation.
Exactly. It completely distorted the price discovery mechanism of the capital markets and created massive, short-term liquidity risks for the NBFCs. Capping it at 1 crore surgically removes the speculative froth without banning the practice entirely.
Surgical intervention. Okay, finally, let's throw in the fintech market projections to contextualize why the RBI is moving so fast.
India's fintech market is projected to reach USD 150 billion by 2025, a massive leap from USD 50 billion in 2021. Furthermore, the fintech adoption rate among consumers in India stands at an incredible 87%, significantly outperforming the global average of 67%.
The technology is scaling at a vertical trajectory, which perfectly explains why the regulations have to adapt so aggressively. All right, take a breath. We have constructed 5 major sections of our mental blueprint. We have the definitions, the history, the players, and the raw math.
Which is a solid foundation.
But rote memorization is fragile. If you just memorize facts, your mind goes blank under the pressure of an exam. To truly bulletproof your understanding, you have to connect the facts with causality. We need to explore Section 6. The specific cause and effect relationships that drive Chapter 10.
I completely agree. Understanding the why makes the what unforgettable. Let's map out the critical logical drivers. We can phrase these as because of X, Y happen statements.
Perfect. Let's start with the rhetorical shift, the death of the term shadow banking.
The causal logic is this. Because the term shadow banking carried inherently pejorative connotations and implicitly suggested illicit, unregulated, or dangerous activity, it actively hindered constructive, objective dialogue regarding systemic risk,
Right.
leading the Financial Stability Board to formally replace it with the neutral, descriptive term non-bank financial intermediation, NBFI, in 2018.
I find the psychology of this fascinating. I mean, the phrase shadow banking sounds like a John le Carré spy novel. It evokes images of unregulated actors moving briefcases of cash in dark alleys, deliberately hiding from the light of the central bank.
Which is an entirely inaccurate portrayal. These institutions operate openly. In emerging economies like India, they are the primary mechanism for financial inclusion. They lend to the farmers, the truck drivers, the small enterprises that the commercial banks ignore.
But because regulators in the West, particularly after the 2008 global financial crisis, viewed non-banks with intense suspicion, they used a term that was inherently insulting.
Yes, and you cannot effectively regulate an industry. You cannot sit across a table and have a transparent, cooperative dialogue about risk models if the terminology you use fundamentally characterizes them as illegitimate actors hiding in the shadows. Changing the nomenclature to NBFI was a necessary psychological reset.
Words shape reality. Okay, let's move to the causal logic of the 1996 crisis. We discussed it in the timeline, but let's crystallize the cause and effect here.
Because the 1996 CRB capital failure exposed the massive, devastating vulnerabilities inherent in lightly regulated deposit-taking non-banks and caused genuine retail panic, a watershed moment in regulatory philosophy occurred, leading directly to the draconian 1997 RBI Act amendments, which instituted compulsory registration and the net-owned fund barriers.
Cause, catastrophic intersection collision.
Yeah.
Effect, traffic lights and speed cameras. Now let's tackle the most profound causal driver of the modern era. The reason the SBR paradigm was born in the first place.
Because the NBFC sector grew increasingly, inextricably interconnected with other core financial markets, specifically commercial banks and mutual funds, it ceased being an isolated island and became a massive potential source of systemic risk transmission.
Right.
This reality rendered the old one-size-fits-all, or deposit versus non-deposit regulatory approach obsolete, leading the RBI to engineer the proportional, deeply nuanced, four-tiered, scale-based regulation SBR framework in 2021.
We really need to dissect that word. Interconnectedness. This is where my indie record label analogy completely shatters. 20 or 30 years ago, if a mid-sized NBFC failed, who got hurt?
Primarily, it's direct stakeholders. The founders lost their equity, and the specific individuals who had placed fixed deposits with that company lost their savings. It was localized tragedy, a contained fire.
But today, the funding model has completely changed. If an NBFC cannot take demand deposits, where does a massive multi-billion rupee NBFC get the vast majority of the capital it lends out to the public?
It borrows at wholesale, it goes to commercial banks and takes out massive corporate loans,
Right.
or more significantly, it accesses the capital markets by issuing commercial paper and debentures.
And who buys that commercial paper?
Liquid mutual funds, debt mutual funds,
And whose money is in those mutual funds?
the retail public.
Huh.
The same middle-class savings that used to sit in bank deposits.
So trace the domino effect for me. A massive NBFC mismanages its risk and suddenly collapses today. What happens?
The fire is no longer contained. The NBFC instantly defaults on its massive loans to the commercial banks. The banks' balance sheets bleed, forcing them to restrict lending across the entire economy to preserve capital.
Wow.
Simultaneously, the NBFC defaults on its commercial paper. The mutual funds that hold that paper suddenly see their net asset value, their NAV, plummet. Retail investors, seeing their safe mutual fund losing money, panic and rush to redeem their units. The mutual funds are forced into a fire sale of other assets to meet the redemptions, completely crashing the broader bond market.
It is a systemic contagion. The primary driver for modern RBI regulation isn't just protecting the poor guy who took a loan from the NBFC. The RBI is terrified of the NBFC sector collapsing and taking the commercial banks and the mutual fund industry down with it.
Precisely. They regulate the NBFCs strictly to protect the banks. The interconnectedness is the systemic risk.
That is a phenomenal insight. Let's do one final causal statement regarding accounting.
Because the new principle-based Ind AS accounting framework inherently introduces subjectivity and massive management discretion, particularly regarding the assumptions built into expected credit loss models. There is an inevitable loss of strict comparability across different financial entities,
Leading
leading the RBI to proactively issue specific, rigid regulatory guidance on Ind AS implementation to artificially enforce consistency and enable reliable macro supervision.
Right, because if every indie record label is allowed to calculate their album sales using a different mathematical formula, Billboard cannot construct a reliable top 100 chart. The RBI needs everyone using the same ruler, even if the underlying accounting philosophy is supposed to be flexible.
Exactly. Flexibility is great for corporate management. It is an absolute nightmare for a central bank trying to monitor a 50 trillion debit actor.
All right, we are entering the final stage of our mental blueprint. Section 7. We have reached the comparative matrix. In our minds, we are going to construct detailed markdown tables to visually contrast the varying categories and regulatory models we've explored. We need to structure the chaos. Let's start with the masterpiece. Matrix 1, the SBR layers. Describe the architecture of the scale-based regulation pyramid.
Picture a four-tiered pyramid. At the very bottom, forming the massive wide foundation, is the base layer, NBFCBL.
Who lives in the base layer?
The vast majority of the 9,000 NBFCs. Specifically, it includes non-deposit-taking NBFCs with an asset size below 1,000 crore. It also specifically houses certain unique specialized business models regardless of their size. Peer-to-peer or P2P lending platforms, account aggregators or AA, and non-operative financial holding companies.
And what characterizes their regulatory environment? Let's get the key regs.
It is the lightest touch the RBI offers. There are no capital to risk-weighted assets ratio, no CRA requirements. They're subject to the 7x leverage ratio limit we discussed, and they are the ones on that slow, agonizing 90-day NPA glide path.
So they are heavily monitored, but not suffocated. Now we move up one level.
The middle layer, NBFC-ML. This is where the scrutiny tightens significantly. This layer captures all deposit-taking NBFCs, regardless of how small their asset size might be.
Because the act of taking public deposits is inherently sacred to the regulator.
Exactly. It also captures non-deposit-taking NBFCs whose asset size crosses the 1,000 crore threshold.
Yeah.
Furthermore, certain high-impact activity-based companies are permanently parked here, such as housing finance companies, HFCs, infrastructure finance companies, IFCs, and core investment companies, CICs.
What does life look like in the middle layer?
Much more demanding. They must maintain a strict minimum CRAR of 15%. They're legally required to conduct that internal self-assessment we talked about, the ISCAP. And they face stringent credit concentration norms, meaning they cannot bet their entire balance sheet on a single horse like a single counterparty exposure limit of 25%.
Moving higher. The elite tier.
The upper layer, NBFCUL, these are the titans, the systemically vital behemoths. The RBI specifically identifies the top 10 eligible NBFCs by pure asset size and places them here automatically.
Just the top 10.
Well, the RBI can also pull other NBFCs up into this layer based on a highly complex proprietary scoring methodology that evaluates their interconnectedness, substitutability, and complexity.
If you are pulled into the upper layer, what happens to your business? What are the key regs?
You are subjected to bank-like prudential regulation. You must maintain the 9% Common Equity Tier 1 capital requirement. You face intense leverage ceilings, differential standard asset provisioning, and mandatory listing requirements within a specific time frame. The supervisory engagement is constant and deep.
Which brings us to the very peak of the pyramid, the capstone, the top layer, NBFC-TL. Who occupies the absolute highest tier of regulation in India?
Ideally, absolutely no one. By design, the top layer is completely empty.
Okay, I have to stop you. Why would the Reserve Bank of India, an incredibly busy institution, spend thousands of hours drafting complex rules, debating clauses, and officially drawing a top tier on their regulatory pyramid, solely to leave it empty? What is the point of an empty box?
It is arguably the most brilliant psychological mechanism in modern financial regulation. The top layer functions as a permanent threat, a nuclear deterrent.
Oh, wow.
The statutory rules explicitly state that the top layer will only be populated if the RBI decides that the systemic risk emanating from a specific NBFC in the upper layer has increased substantially to an unacceptable, dangerous level.
It is the ultimate penalty box.
Exactly. If you are the CEO of a multi-billion-dollar upper layer NBFC and you start chasing yields, taking excessive risks, lowering your underwriting standards, the RBI does not just send you a warning letter or levy a small fine. They forcibly push you up into the top layer.
And what happens in the top layer?
The oversight becomes incredibly punitive and suffocating. Capital charges skyrocket. Business restrictions are imposed. The regulator practically lives in your boardroom. No corporate management ever wants the market stigma, the sheer panic from investors, or the operational paralysis of being designated a top-layer risk.
So the mere existence of the empty box modifies the behavior of the titans. They proactively self-regulate, they hold extra capital, they temper their aggression, specifically to ensure they never trigger the trapdoor that drops them or pulls them up into the top layer. The most powerful layer of regulation is the one that no one is actually in.
It is a masterclass in behavioral economics applied to macro supervision.
Incredible. Okay, Matrix 2 is a brief contrast. NBFCs versus bank prudential regulation.
The core contrast is capital and accounting. As we noted, an NBFC in the base layer has zero CRAR requirement. A commercial bank, however, faces a rigid minimum 9% CRAR plus mandatory capital conservation buffers and counter-cyclical buffers that scale with the economy.
And the accounting norms.
On the accounting side, NBFCs rely primarily on the Companies Act and Ind AS. Banks operate under a much more complex, rigid melange of statutory requirements, specific RBI master directions, and self-regulatory organization guidance. Banks are fundamentally more constrained.
All right, our final construct, Matrix 3. Key activity-based NBFC categories. We established that 96% of the sector is lumped into the investment and credit company, the ICC bucket. Let's isolate a few of the highly specialized models that the exam will undoubtedly test.
Let's start with the macro builders, the NBFC-IFC, the Infrastructure Finance Company.
What is their defining test?
They must employ a minimum of 75% of their total assets, specifically into infrastructure loans.
Why do they get their own category? Why not just let an ICC fund a toll road?
Because of the massive asset-liability mismatch inherent in infrastructure. Building a deep-water port or a national highway takes 10 years before it generates a single rupee of revenue.
Right.
If an NBFC borrows money on 3-year bonds but lends it out for a 15-year infrastructure project, they face an immense liquidity crisis. The RBI created the IFC category to allow for specialized regulatory forbearance regarding concentration norms and external commercial borrowings, enabling them to handle those massive long gestation projects.
They need special rules because they are bending the standard laws of financial physics. Okay, next, the CIC, or Core Investment Company.
The defining test for a CIC is that 90% of their net assets must be investments in equity shares, preference shares, or loans exclusively to their own group companies.
This sounds like a holding company for a massive conglomerate. Think of a massive family-owned corporate empire in India with interests in steel, telecom, and retail. The CIC sits at the top, holding the shares.
Exactly. And the crucial regulatory rule for the exam. CICs are strictly prohibited from actively trading in these shares or bonds. They are not allowed to act like a hedge fund, day trading their subsidiary stock. They can only execute block sales for the explicit purpose of dilution or strategic divestment.
Third specialized category, the NBFC MFI, the microfinance institution.
The test here, 75% of their total assets must be deployed in qualifying assets, which are strictly defined as microfinance loans. These are small, collateral-free loans extended to low-income borrowers, typically in rural or semi-urban areas.
This is the Grameen Bank model, right? Extending credit to people who don't have a house or a car to put up as collateral. How do they mitigate the risk if there is no collateral?
Through sociological engineering, primarily the joint liability group model. They lend to a small group of women in a village. If one woman defaults, the entire group is cut off from future credit. The social pressure and community collateral replace physical collateral. The MFI regulations are highly specialized to protect these highly vulnerable borrowers from predatory pricing or coercive collection tactics.
Financial inclusion at the grassroots. Finally, let's look at the two fascinating fintech categories that represent the bleeding edge of the sector, NBFC P2P and NBFC AA.
Yes, the peer-to-peer lending platform, P2P. The exam will attempt to trick you on the mechanics of this model. A P2P platform is purely a digital facilitator. It provides the technological marketplace that brings a lender with surplus cash directly together with a borrower who needs a loan.
It is the digital matchmaker.
Yes, but the absolute inviolable rule is this. The P2P platform is strictly forbidden from lending its own money from its own balance sheet. They take zero credit risk.
Oh, so they just connect the people.
Right. The money moves from a lender to the borrower through escrow accounts. If the borrower defaults, the individual lender takes the hit, not the platform.
The platform just collects a fee for making the introduction and doing the background check. And the final category, the account aggregator, AA.
The AA represents an entirely new paradigm. Their business model isn't money, it is data. An account aggregator retrieves, consolidates, and presents your financial data from your bank, your mutual fund, your insurance provider, and securely shares it with a lender so they can instantly evaluate your creditworthiness.
So instead of me printing out 6 months of PDF bank statements and handing them to a loan officer, the AA uses an API to securely pull the data and send it.
Exactly. But the golden regulatory rules for AAs are absolute. First, they can only operate with the explicit, granular, revocable consent of the customer. Second, they are completely data blind.
What does data blind mean?
The data moving through their system is asymmetrically encrypted. The AA cannot read your bank statements, they cannot store your data, and they cannot use it to sell you products. They are merely the secure, encrypted pipes.
They are the ultimate manifestation of the new digital economy. Data empowerment without data exploitation. And with that final piece, we have completed our architectural blueprint. I want you to take a mental step back and look at the massive map we have just constructed together.
Twice as sure.
We started with the murky, exclusionary definition of what an NBFC is, distinguishing it from banks by its inability to hold demand deposits or issue checks.
We traced the chronological evolution, witnessing the regulator transform from a passive observer in 1963, shocked into action by the CRB capital failure in 1996, eventually leading to the sophisticated SBR paradigm in 2021.
We locked down the critical terminology, the rigid 50-50 principal business test, the intricate calculation of net owned funds, and the subjective complexity of the expected credit loss models under IND AS. We mapped out the jurisdictional borders, showing why SEBI and IRD watch their own sectors to avoid dual regulation.
We extracted the vital empirical data, the massive concentration of ICCs, the methodical glide paths for NOF and NPA recognition designed to prevent artificial insolvencies, and the stringent capital ratios.
We deeply analyzed the cause and effect drivers, exposing how the interconnectedness between NBFCs, commercial banks, and mutual funds transformed a localized risk into a massive systemic contagion threat.
And finally, we built the comparative matrix, breaking down the specific mechanics of infrastructure finance, holding companies, microfinance, and the four-tiered SBR pyramid with its terrifying empty top layer.
If you can visualize that blueprint and understand the causal logic connecting these pillars, you have fundamentally mastered Chapter 10. You do not just know the rules, you understand the profound economic engine underneath them.
Yes, congratulations. You are officially equipped for your exam, your meeting, or whatever challenge requires this level of mastery.
But before we officially sign off, I want to leave you with one final provocative puzzle to mull over. We just spent an hour discussing how fintech innovations like peer-to-peer lending platforms and account aggregators forced the Reserve Bank of India to create entirely new, highly specific regulatory categories just to handle them. The rules were forced to adapt to the reality of the technology.
And the fundamental truth of technologies is that it never, ever stops evolving.
Exactly. So look out at the horizon. Look at the rapid global rise of decentralized finance, or DeFi. Look at AI-driven autonomous lending protocols that currently operate entirely on public blockchains via self-executing smart contracts. Ask yourself, will the RBI's highly sophisticated four-layer SBR pyramid be enough?
That's a huge question.
Or will the regulator very soon need to create a fifth dimension, an entirely new regulatory framework just to handle algorithmic code that acts as a financial institution, but has no physical office to inspect, no human board of directors to supersede, and no CEO to put in the top layer penalty box?
That is the ultimate frontier of systemic risk and financial regulation.
And it brings us right back to our opening thought. In the world of non-banking finance and rapid technological innovation, that beautifully clear X-ray machine is always going to be a little bit broken. The landscape will continually remain fluid and mucky, and the regulator will always be engaged in that desperate balancing act, trying to harness the light of financial innovation without being swallowed by the shadow of systemic collapse.
Absolutely.
Keep diving deep, trust the blueprint you've built today, and the very best of luck on your upcoming exam. We will catch you on the next deep dive.